This is your XRP when you hold it, and this is your XRP when you hold and get a passive yield. If you believe XRP is worth more than it is today, say 10, 20, even $100, this is powerful. XRP has a lot of things going for it, but one downside has always been the lack of passive money-making opportunities for XRP holders until recently. In the near future, thanks to another cryptocurrency called Flare, and right now, thanks to the XRP Ledger automated market maker pools, there is huge potential for passive income for XRP holders, but there's also huge risk. So in this video, we'll go over what you need to know about XRP passive income without getting too technical so we all understand what's actually going on. We'll also go over some historical context about crypto and passive income, go over the ways our crypto can earn us passive income, get into the specific ways XRP holders can do this using Flare and the AMM pools. I'll sprinkle in some key information that always seems to get left out of this conversation throughout the video and give you my observations from last cycle that we should be aware of, because it can mean the difference between walking away with a lot of money or giving it right back to the markets. At the end of this video, you'll be able to make a decision on your own if you want to go further down the crypto passive income rabbit hole, and at the very least, we'll be better prepared to handle a crypto bull market and walk away making more money. All right, let's get started. Hi, I'm Raj. On this channel, we talk about money, and in this video, passive income with XRP holdings. Remember, I can't give you financial advice. I'm simply not qualified to do that, but I can tell you that how you play this crypto passive income game is up to you, but getting it wrong in either direction means losing out on a huge amount of money. There's a chance we could be in early on one of the biggest opportunities with one of the highest potential cryptos, maybe even finding ourselves in a position where we never sell our XRP and live off the yield, and at the same time, there's a chance we could lose our XRP, like just gone. No givebacks, redos, mulligans, hitting the reset button, asking the devs to do something. Help me, David Schwartz, you're my only hope. None of that. So first, some context. Passive income isn't passive. There are varying degrees of how passive it can be, but it is usually not zero and has pros and cons depending on how it's earned. If you don't get that, you will get wrong-footed in the market chasing passive income. There's always some amount of work needed to get things going and some risk involved. For most people, active income comes before passive income, and for a majority of the time, the active income earns way more than the passive income. We all have to do some work and put in some effort to earn money, to then buy assets, and then we can earn a bit on the side from just owning them with the hopes that one day the investment income can replace and even surpass the money we would make actively. So it's work, which turns into money, which is then invested over a long period of time and hopefully compounds, that then pays us. Or work turns into an asset directly, like a YouTube video, a digital product, a book, a movie, a song, then that earns in the background independent of our time. So how does this apply to crypto? In the early days, back when Bitcoin is being mined from regular hardware in people's homes, you could actually get a lot of Bitcoin as a reward for mining because there was less competition and the BTC rewards were just a lot higher. Bitcoin was also worth a lot less back then, so let's not get carried away. And what people forget is that it was also a lot more difficult to get started. The programs used were not user-friendly like a lot of crypto platforms today, so a bit of technical know-how was also required. And it also cost money to get the ability to mine. You would have needed a beefier computer to get going, which added cost. Electricity was also a factor since these miners are running 24/7. And Bitcoin's price fluctuated, so it wasn't always profitable to mine directly. We would have had to mine and wait for the market price to go up, which in some cases took years. Bitcoin is also closer to magic internet money than a new asset class on government and company balance sheets. And there was a real chance of setting your mom's basement on fire. That's not exactly ideal. So today, if you're a solo miner on a limited budget, your chances of outcompeting entire mining farms are basically zero. So this really isn't an option for most people today, unless you want to join a mining pool and split rewards with some fees tacked on, or want to consider cloud mining without all the hardware requirements, but your mileage may vary. There's a lot of scams in the space, so be careful. Of course, more blockchains have developed as crypto has evolved, and Ethereum gives us the ability to use smart contracts. These work on an if this, then that basis. If the Eagles win the Super Bowl, you pay me. If another team wins the Super Bowl, I pay you. In this scenario, this would happen automatically once we set it up. That's just a small example of a very simple smart contract. In the early days of Ethereum, we could mine it just like Bitcoin, but Ethereum has since switched to a different way of operating. This means its blockchain operates in a slightly different way than Bitcoin, and that opens it up to different benefits but also security risks. For example, someone could just flood the system with bogus transactions, grinding everything to a halt. As a way to secure the Ethereum network from attacks, the blockchain allows for holders to lock up some of their coins, decreasing the ability of a flood of transactions to attack the network. And as a reward for this, the locked Ethereum generates a yield, paying people to make the network they're using to get paid passively more secure. To put it very simply, Ethereum has staking, which is when we lock up our Ethereum that we bought or previously mined, which to be clear, we no longer can do, to help secure the network, and in return, we earn Ethereum. It's a little more complex than that, but this is the overall concept and is a great positive feedback loop with a lot of winners. If that all sounded too complex, let's just break it down. There are some very easy ways to access passive income with crypto right now. Investors can buy stablecoins and other cryptos and earn a yield on exchanges, which is pretty straightforward. You just buy the coins and opt into earning yield. And another method is through an airdrop, which is more random. This is when holders of a crypto get another crypto just for holding. For example, if you were an XRP holder on the blockchain snapshot date of December 12th, 2020, you were likely eligible for an airdrop of the Flare token. These are still being distributed, and the last of the airdrops is set for January of 2026. So for XRP specifically, we cannot mine for and we cannot stake XRP because of how its blockchain operates. The first of two methods to use XRP for passive income is through another cryptocurrency called Flare and the Firelight protocol. This solves a problem for XRP. XRP itself is exceptionally good at one thing: transferring value. Bitcoin and Ethereum on a good day are slow and expensive for transfers, and when the networks get busy, these fees go up massively and the transaction times do as well. In some cases, they don't even go through it all and still charge for the fees. But XRP has limitations. There's no smart contract capability on the XRP ledger. What Flare does is increases the utility of XRP and allows holders to participate on other blockchains through their XRP holdings, and this opens up passive income opportunities. So how would this work exactly? How does one blockchain connect to another? The idea in this case is that we would take our XRP and redeem it for FXRP on the Flare network. Flare would be acting as a middle ground, which allows us to convert XRP into something on another blockchain. And no, the XRP converted does not just disappear, it just stays on the XRP ledger, but is taken out of the circulating supply and put into an escrow. If you want your XRP back, you trade your FXRP back to XRP, and then the XRP is available again. This means that using the Flare network to give XRP smart contract capability also means it decreases available XRP supply. You can then take this FXRP and use it to generate a yield through DeFi, staking, or any other use case not limited by one blockchain. And this is generally what you need to know in regards to how this whole passive income with Flare works. From here, the details get extremely technical and complex, and to be honest, I don't fully understand that component myself. This is a new frontier in crypto, and there's a lot we just don't know yet, because this actually isn't available just yet. Now, most people, broadly speaking, weren't XRP holders back in December of 2020, so there's no Flare airdrop to claim, and Flare's Firelight protocol isn't ready today. But what is working today is the XRP ledger's automated market makers. This is where holders can become liquidity providers for trading pairs and earn fees for doing so, meaning you provide your coins to a pool, and to be very clear, this means giving up control of your XRP. So when other people trade a pairing, you earn a fee when those trades happen. If you contribute XRP to a liquidity pool, let's say XRP and RLUSD, you gain the benefit of earning from the fees associated with those trades other people make of that pair. But there is a risk of a rug pull. This is when a bad actor can just take the money from the pool and you end up losing the crypto you put in, and the same thing can happen from a bug in a smart contract. Now, those two are bad, but we need to talk about one other type of risk, and that's the risk of impermanent loss. Now, this sounds scary, but it's not actually that bad. It's just something that you absolutely should know about if you decide to go down this path. This is where you put two tokens in a pool, and the price of one token changes compared to the other while your funds are in the pool. Because automated market makers use a formula to keep the pool balanced. Let's just say it's simple, like X times Y equals Z. the pool would automatically adjust your tokens. This means you end up holding a different mix of tokens when you withdraw than when you originally deposited. For example, let's say you provided liquidity to an XRP RLUSD pool where you deposited 1,000 XRP and the price is $1 and 1,000 RLUSD for a total deposit of $2,000. Now let's say XRP doubled to $2. If you just held, that 1,000 XRP would be worth $2,000 and that 1,000 RLUSD would be worth $1,000 for a total position of $3,000. In the liquidity pool with AMM rebalancing, the pool forces the ratio between XRP and RLUSD to adjust. So instead of 1,000 XRP, you'll now hold potentially fewer XRP, but more RLUSD. So roughly, you'd potentially withdraw 707 XRP and 1,414 RLUSD. This would give you a total of $2,828. So the difference is $172 of impermanent loss. You didn't actually lose money, you still gained $828 in value, but you gained less than if you just held XRP and RLUSD outside of the pool. So it's relative to just holding. And this also doesn't consider the fees or liquidity pool tokens you would earn that you could use to trade back for XRP. So this is obviously a hypothetical example to better explain impermanent loss, but generally speaking, if you want to provide liquidity in an AMM pool, you're giving up some upside if one coin goes up in value relative to the other in exchange for earning fees, which maybe for a very long-term holder might be worth it depending on the XRP pairing, but the key word is impermanent because the price of the assets are dynamic and the AMM pool would obviously balance out your position. So with all that being said, legitimate passive income does exist in crypto. We have moved in the right direction away from the Ponzi's and backdoor scams from 2021. There were protocols offering huge percentage points in yield that compounded as frequently as 8 hours in some cases and had insane buy and sell taxes. This means that when you bought into the scheme for, let's say, $100, a buy tax would take effect and your $100 would be worth less immediately. And when your investment became worth more, even if you wanted to get your money out, a sell tax was in place, which delayed your ability to get your initial money out, effectively trapping your money. These were obviously Ponzi schemes where the money being paid to holders was coming from new buyers, and also a tax nightmare. But greed was everywhere and it was hard to see for a lot of us in the moment. Even FTX was offering crazy high yields just for putting money on their platform. And now we know why they were doing that. They took customer money to trade with on the back end until it all went under. So fast forward to today, a lot of positive developments have occurred for XRP and crypto, like legal victories and guideline regulations, which opens up more legit opportunities. So with all that being said, what kind of rewards are we talking today? In terms of the easiest options for crypto passive income, on Coinbase, staking Ethereum will yield you about 2% a year, holding USDC will yield 4%, and staking Solana about 5%. These rewards are paid out in the same currency as where you're using to get them. So ETH staking pays ETH, USDC pays USDC, and Solana pays Solana. With the XRPL AMM pools, yields from about 5% providing liquidity to the XRP RLUSD pair are possible, and for riskier options, mostly meme coins, 8, 15, and even higher in some cases are options. In this situation, the AMM pools pay liquidity providers based on the fees charged to traders. These payments are the yield and are paid in liquidity tokens, which represent a liquidity provider's overall percentage share of the liquidity. The more liquidity a user gives, again to be clear, this means giving up control of your XRP and giving it to the pool, the more fees they collect. They would need to sell or take out their liquidity tokens, trading back for the original assets put in order to realize their gains. So unlike Bitcoin, Ethereum, and other crypto passive income opportunities at the time of making this video, there is no passive income opportunity for XRP that exists that pays out XRP directly. And the only one on the XRP ledger involves giving up control of your XRP, which brings us to the risks. In general, the risk is money we have in crypto at any given moment, max loss. And of course, we should keep in mind any rewards earned would be taxable no matter what form the rewards are in, either crypto, cash, stablecoins, liquidity pool, anything. If you decide to get in on some crypto passive income, I highly recommend using a crypto tax service because all exchanges and networks do not communicate all of your transactions. The data is fragmented. So using a tax software puts all your transactions in one place, which makes calculating gains, losses, and tax obligation way easier. The one I use is called CoinTracker. That works for me, and there's an affiliate link below. I get a small commission if you sign up using it. So is the risk worth it? This is entirely up to every investor to decide on their own. For me right now, crypto passive income in general is not something I'm entertaining because the risk of losing my coins doesn't justify the yields I could be getting today compared to the multiple X returns that are possible down the line. One huge issue I saw last market cycle was the trend of people getting ahead of themselves, prioritizing passive income before active income. This really isn't an issue until extreme greed hits the market. And if you're a holder of XRP, if the next bull market is anything like the last one, people will try to get you to give up control of that XRP. Not all of them want to work with you for a better outcome for both of you. They just want to take your money. So crazy high yields will be on the table. All sorts of great ideas, the keyword is ideas, get very popular, and everybody starts throwing caution out the window because it's green candles and everybody's richer, number only goes up. It becomes max risk YOLO investing season. It's fun and crazy and temporary. Eventually the markets tank and all the risk turns into real losses. So before we get to that part, let's put on some armor so we can defend ourselves and make it out of the markets with more profit this time. The two questions I would ask first about any opportunity where XRP and passive income is involved are, where is the yield or the money coming from? This should be very obvious and verifiable. And two, is the yield sustainable? This ideally would be answered as yes, but this is where most opportunities don't pass the test. This is just a starting point for research, of course. Things like, how long is it going to take to get the XRP back out of the protocol? We want it. How long until we get our initial investment back? Are there fees when we buy and sell? Who's involved? And there are so many more questions to ask, but to sum it all up, most crypto passive income opportunities, even legit ones, aren't worth it today from a risk to reward perspective, in my opinion. New ones will likely appear, some will be legit, some will be scams, and for me, and most likely for you as well, buying and holding is generally the best strategy. To prove it to myself, I went through my own trades since 2017 using CoinTracker. I know that personally, buying and holding has been my most profitable strategy over the years, and I made a video documenting that if you're interested in learning from my mistakes. With all that being said, I'm interested in your thoughts as well, so leave them in the comment section, and I'll see you in the next video. Thanks for watching, and have a good one.